Have you ever had the idea that the price of a stock, index, or ETF is going to make a big move, but you just weren't sure about which direction? Perhaps it's an imminent earnings release, or there's an anticipated event, such as a Federal Reserve meeting. If that's the case, then a long straddle could be a great way to take advantage of a big price move. The long straddle is an option strategy that consists of buying both a call and a put with the same strike price and the same expiration date at the same time. Typically, you're buying the straddle with at-the-money options, which means the strike price that's closest to where the stock is currently trading. Because you are uncertain of the direction the stock will move, the long straddle is designed to profit from a rise or fall in the stock price, provided the move is big enough. The idea is simple. If the stock rallies and the profit from the call option outweighs the cost of the put, then the net is a profit. And if the stock drops, as long as the put option outweighs the cost of the call, you will also have a profit. With XYZ stock trading at $45 and an earnings report around the corner, let's assume you buy the 45 straddle with 60 days to expiration. You purchase the 45 strike call for $2.40 and the 45 strike put for $2.30 for a net cost of $4.70. The goal here is for the combined value of both options to exceed $4.70 in value in order to make a profit prior to or at expiration. If XYZ makes a big enough move to the upside, then the profit from the call can overcome the cost of the put, giving you a net profit on the trade. The same thing can occur if the stock drops, where the put option profits more than the cost of the call, giving you a net profit on the trade. What happens after the stock moves? Let's assume that XYZ announces great earnings, and the stock moves higher to $50.80. How did your straddle do? Since the stock moved higher, the call side of the straddle is now $6.10, while the put is worth only 30 cents, for a combined value of $6.40. Since you paid $4.70 for the straddle, which is now worth $6.40, you have a net profit of $1.70, which is $170 per straddle. That's a profit of about 36%, while the stock rallied only about 13%. Had the stock fallen after an earnings report by a similar amount, your put option would have likely increased as your call option decreased. That's the beauty of the long straddle. You don't care where the stock goes as long as it has a big move in one direction or the other. What happens if the stock doesn't move much in either direction? One thing that's working against you in this trade is time. Each day, both options incur time decay, which is a loss in premium due to the passing of time as the options approach expiration. Options that have an expiration further out in time have more time premium than options that are near term. The total amount of money at risk in this trade is the amount you paid for the straddle, in this example, $470 per straddle. In order for this trade to break even at expiration, XYZ needs to move either higher or lower from $45 by the amount you paid for the straddle. So in this example, the break-even prices are $40.30 to the downside and $49.70 on the upside. The trade profits from any stock price lower than $40.30 or higher than $49.70. And the only way that you can lose the entire amount would be to hold on to the trade until the expiration date, with the stock closing exactly at $45. Because the straddle is a breakout strategy and typically depends on a market-moving event, it is unlikely you will hold it until expiration. Once the stock has made the move you were looking for, most traders close the trade. Implied volatility plays a big part with the long straddle. When implied volatility rises, both call and put premiums increase. When implied volatility falls, both call and put premiums decrease. As an alternative to the straddle, the Long Strangle is similar in design but requires a greater move in the stock in order to profit. To learn more about the long straddle, volatility, and other strategies, Visit the OIC website at optionseducation.org.